Good morning, students. Today, our topic of discussion is money and credit. Good morning, students. Today, we'll be talking about double coincidence of wants and barter system. What is barter system, students? In the olden days, when money wasn't part of the economic system, barter system was used. Barter system was used to exchange goods. So there was no money involved, and the only way people could buy other goods is by exchanging goods they had. For instance, there was a wheat seller and a shoe manufacturer. So if the wheat seller wanted shoes, he wouldn't pay money, instead, he would exchange his wheat for shoes. That is called barter system. And what is double coincidence of wants? Double coincidence of wants is, for instance, if the shoe manufacturer wanted wheat, he not only looked for a wheat seller who would be interested to sell wheat, but in exchange of shoes. What is double coincidence of wants, children? If the shoe manufacturer wanted wheat, he looked for a wheat seller who would sell wheat in exchange for shoes. That is called double coincidence of wants. Let's elaborate on that, students. Take the case of a shoe manufacturer. He wants to sell shoes in the market and buy wheat. The shoe manufacturer will first exchange shoes that he has produced for money and then exchange the money for wheat. Imagine how much more difficult it would be if the shoe manufacturer had to directly exchange shoes for wheat without the use of money. He would have to look for a wheat growing farmer who not only wants to sell wheat but also wants to buy the shoes in exchange. That is, both parties have to agree to sell and buy each other's commodities. This is known as double coincidence of wants. What a person desires to sell is exactly what the other wishes to buy. In a barter system where goods are directly exchanged without the use of money, double coincidence of wants is an essential feature. Let's repeat this again, students. In a barter system where goods are directly exchanged without the use of money, double coincidence of wants is an essential feature. Hi, students. Money has three main important properties. Money is the medium of exchange, money is a unit of account, and money is a store of value. What is money as a medium of exchange? It means that money acts as an intermediary between the buyer and the seller. So money acts as the intermediary between the buyer and seller. So if the wheat seller wanted shoes, instead of exchanging wheat for shoes, he would use money to directly buy shoes. So it is a medium of exchange. What is money as a unit of account? It is something that can be used to value goods and services. A chocolate is 10 rupees. A bike is 2 lakh rupees. So it can be used to value goods and resources. So money is a unit of account. And finally, money can be considered a store of value, which means it can be used as a means of saving and allocating capital. My worth is 2 lakh rupees, or my savings is 10 lakh rupees. So money can be used as a store of value. Hello, students. There are two modern forms of money. One is currency and the other one is bank deposits. What is currency, students? Currency includes paper notes and coins. In the olden ages, there were gold coins, silver coins, and bronze coins. But these days, we only have one type of coins. And the other form of money is paper notes. It is accepted as a medium of exchange because the currency is authorized by the government of India. As per Indian law, no other organization is allowed to issue currency other than the Reserve Bank of India. Moreover, the law legalizes the use of rupee as a medium of payment that cannot be refused in settling transactions in India. The law legalizes that rupee can be used in transactions in India and no one can refuse rupee as a medium of exchange or a medium of transaction. The other form of modern money is bank deposits. Banks accept the deposits and also pay an amount as interest on the deposits. In this way, people's money is safe with the banks and it earns an amount as interest. People also have the provision to withdraw the money as and when they require. Since the deposits in the bank accounts can be withdrawn on demand, these deposits are also called demand deposits. Since the deposits in the bank accounts can be withdrawn on demand, these deposits are called demand deposits. Modern banks have two main important functions. The first function is to accept deposits from the consumers. They accept deposits as cash and offer an interest payments on the deposits. 2. The second function of the modern banks is to offer or extend loans to consumers. Let's say this again, students. The second function of modern banks is to extend or offer loans to consumers and charge interest. Banks keep only a small portion of their deposits as cash with themselves. Banks keep only a small proportion of the deposits with them as cash. For example, banks in India these days hold around 15% of the deposits as cash. And what happens to the remaining amount? What happens to the remaining amount? It goes as funds to create or extend loans. This is kept as provision to pay the depositors who might come to withdraw money from the bank on any given day. Banks use the major portion of the deposits to extend loans. What is it, students? Banks use a majority of these deposits as funds to extend or give loans to people. There is a huge demand for loans for various economic activities. Banks charge a higher interest rate on loans than what they offer in deposits. Banks charge a higher interest rates on loans than what they offer on deposits. The difference between what is charged from borrowers and what is paid to depositors is their main source of income. The difference between what is charged from borrowers and what is paid to depositors is their main source of income. Hello students. In this video, we will be discussing what means collateral. Collateral is an asset which is owned by the borrower and it is given to the lender as a guarantee for the loan. Let's repeat this again, students. Collateral is an asset owned by the borrower in terms of land or livestock or property or vehicle, which is used as a guarantee to the lender until the loan is repaid. Collateral is an asset that the borrower owns, such as land, building, vehicle, livestock, deposit with banks, and uses this as a guarantee to a lender until the loan is repaid. If the borrower fails to repay the loan, the lender has the right to sell the asset or collateral to obtain payment. If the borrower fails to repay the loan, the lender has the right to sell the asset or the collateral to obtain the payment. Hello students. There are two major types of loans. One is formal sector loans and the second one is informal sector loans. What are formal sector loans? Formal sector loans are loans that are issued by formal organizations or legal organizations such as banks and cooperatives. Let me say that again, students. Formal sector loans are loans which are given by formal sector organizations such as banks, cooperatives. Informal sector loans are those loans which are given by informal lenders such as households, landlords, relatives, family, etc. Let us go into more detail. The various types of loans can be conveniently grouped as formal sector loans and informal sector loans. Formal sector loans are given by banks and cooperatives. and informal sector loans are given by informal lenders like households, money lenders, traders, family, etc. The Reserve Bank of India supervises the functioning of formal sources of loans. The Reserve Bank of India supervises the functioning of formal sources of loans. For instance, we have seen that banks maintain a minimum cash balance out of the deposits they receive. The RBI monitors the banks in actually maintaining the cash balance. Similarly, the RBI sees that the banks give loans not just to profit making business and traders but also to small scale cultivators and industries. RBI sees that the banks give out loans not just to profit making industries but also to small traders and small businesses and small borrowers. Periodically, banks have to submit information to the RBI on how much they're lending and to whom, at what interest rate, etc. Periodically, the banks have to submit information to the RBI regarding to whom they are lending, at what interest rate, etc. There is no organization that supervises the credit activities of lenders in the informal sector. There is no organization that monitors the activities of loans in the informal sector. This is the reason why most lenders in the informal sector charge a higher rate of interest than the formal sector, leading to a debt trap among the people who take informal loans. Informal lenders can lend at whatever interest rate they want compared to formal lenders. For these reasons, banks and cooperative societies need to lend more because they're cheaper and they're formal. Once they're cheaper, the lender has more income at hand to dispose it to other needs and expenses he wants. If the person lends in the informal sector at a higher interest rate, then he has less income disposable at his hands to meet his expenses. Cheap, cheap and affordable credit is crucial for the country's development. Cheap and affordable credit is necessary for country's development.